Glenn, always good to see you.
Good to see you.
And you're smiling even though it looks like the housing market is slowing. Tell me, Glenn, in 6 months, is the market going to be better or worse?
Probably the same. Rates
Why?
are probably going to 6%. Inventory is increasing. Sales volume will be somewhat fine, but prices are going to soften.
So prices will soften. So therefore, you're going to make it more affordable, basically. So you're going to make up on the hike in mortgage rates. How about the dynamic, though, of people who have to sell their homes in order to buy another home? Why, if I have 3.5% or 3.25% now, the thought of paying 6% for a bigger house is really tough.
That's where the market is really going to be pinched. So many people are locked into the home they're living in now by a 30-year, 3.5% mortgage. So they're going to stay in that property forever. Maybe they will rent it out. But if they actually want to move up, they are going to have a hard time affording the next place. If you combine interest rates with what's happened to home prices over the past year, the mortgage payment for a median price home in the United States is up 43%. So buyers are saying I've had enough, and sellers are starting to freak out a little bit.
Is now the time to buy? I mean, if sellers are freaking out, if you're opportunistic, maybe now's the time to take advantage of that before rates really go to 6%.
I think so. Obviously, I'm bound to feel that way because I'm a real estate broker. But the honest truth is, if you're going to stay in a house for 5 years, you're going to do just fine in this market, and you're probably going to get yourself a good deal. If you plan on flipping the property or you're trying to make money as an investor, I think that proposition has gotten more dicey.
Can you give us some nuance in terms of where the biggest slowdown can happen? We've gotten some data points over the past couple of days. Toll Brothers had better than expected earnings. Those buyers tend to be higher end, higher income buyers. Williams-Sonoma guided higher. They tend to cater to a higher income household. What are you seeing in terms of the type of home buyers that will stay in this market that is more expensive?
Well, it's the secondary markets that have been hit the hardest. So if you look at Tacoma, Washington, or Sacramento, California, refugees who leave the Bay Area or the Seattle area looking for value have been going to those markets and just sent prices through the roof. And now those prices are taking a step back. We're also seeing affordable second home markets like the area in Sarasota, Florida, really taking a step back on prices. So that's where the price reductions are most common. One reason that the Federal Reserve hasn't been able to limit demand probably as much as it planned to is that when Charlotte gets too expensive, people look at Charleston, South Carolina. When San Antonio gets too expensive, people look at El Paso. We're seeing home buyers being much more omnivorous about where they live and what kind of home they want to buy than they used to be because remote work has untethered them. So that's the one silver lining in all of this, that when one market gets too pricey, people look at another.